Hey everyone, and welcome to this explainer. I am incredibly excited to have you here today because we're going to be diving into something that is absolutely fundamental to any successful organization. We're talking about finance, but we aren't just talking about, counting pennies in a back room. We're looking at the heavy-hitting finance functions within financial management. You can really think of finance as the ultimate fuel that powers every single aspect of modern business, because without it, the engine literally doesn't run. So, what actually keeps a business alive? I want you to really chew on that for a second. You might immediately think it's your brilliant marketing strategy, or maybe your dedicated HR department, or your cutting-edge research and development team. And yes, absolutely, those are vital. But here's the reality check. Every single one of those departments requires funds to operate. They are all powered by one critical lifeblood, and that is finance. To kind of ground our understanding before we get into the weeds, let's look at this classic definition from Howard and Upton. They define financial management as the application of the planning and control functions to the finance function. Basically, what they mean is that managing money isn't just about recording what comes in and what goes out. It's about rigorously applying core management principles like planning ahead, organizing, directing, and controlling specifically to your financial resources to make sure they're working as hard as possible for you. All right, here is our roadmap for today's explainer. First, we'll hit maximizing wealth. Then we'll break down the 4 pillars: financing decisions, investment decisions, dividend decisions, and balancing liquidity. Let's get right into it. Section 1, objectives of financial management, setting the ultimate goal. So before looking at the functional pillars of day-to-day management, what is every financial manager actually aiming to hit? Well, historically, the traditional objective was pretty straightforward: profit maximization. Basically, just boost revenue and slash costs right now, today. But modern finance has a much more holistic goal, which is wealth maximization. This means making strategic decisions that steadily increase the overall market value of the company's shares. It's really about long-term value creation for the owners and shareholders, not just making a quick buck today. Section 2, Pillar 1, financing decisions, or procuring the funds. Look, before you can spend money, you have to figure out exactly where your capital is actually going to come from. And this whole thing kicks off with solid financial planning by forecasting exactly what you're going to need, setting objectives, formulating policies, writing out the budget, and then monitoring performance. A business can accurately estimate its capital requirements. This is absolutely crucial because if you estimate poorly, you fall into the trap of either undercapitalization, where you just don't have enough money to keep the lights on, or overcapitalization, where you're sitting on inefficient, idle cash doing nothing for you. So, once we know how much cash we actually need, we can neatly categorize our procurement options. We can look inward at internal sources, like retained earnings or depreciation funds, or we can look outward at external sources. That means raising money through equity shares, debentures, bank loans, or even pitching to venture capital. But here's the catch. You can't just pick your sources at random. It's like a giant puzzle. A financial manager continuously evaluates their capital structure to find the absolute optimal mix. Let's say 60% equity and 40% debt, for example. The ultimate goal here? Minimize your overall cost of capital while keeping your financial flexibility high and your risk low. Section 3, Pillar 2, investment decisions, or utilizing the funds. Okay, so we've procured our funds at the lowest possible cost. Now we have to decide exactly where to allocate that money to generate the absolute maximum returns. When we talk about these big, long-term investments, we are talking about capital budgeting. This is essentially your long-term asset mix decision. You aren't just buying paper clips and office supplies here. You are evaluating major, multi-year projects. Think buying a new piece of heavy machinery, launching an entirely new product line, or building a brand new factory. These are investments that will completely dictate your cash inflows and outflows for years to come. Because these decisions are so massive, you need a highly rigorous evaluation process. A project is only ever accepted if its prospective return outpaces the cutoff rate, which is your required rate of return. And financial managers, they don't just guess and cross their fingers. They verify this using advanced mathematical methods like net present value, or NPV, and internal rate of return, or IRR. Basically, if the math doesn't make sense, the project gets rejected, no exceptions. Section 4, Pillar 3, Dividend Decisions, which is all about managing the profits. Let's assume we made some brilliant investment decisions. The new factory is humming along, the products are flying off the shelves, and the business is highly profitable. What exactly do we do with all this surplus profit? Well, now we hit the core dilemma of the dividend decision. On one hand, your shareholders invested in you, right? They want a return, so you could distribute the net income directly to them as cash dividends. On the other hand, you could keep that money as retained earnings, plowing it right back into the business to buy more machines and fuel even more future growth. So how on earth do you make that call? Well, you have to determine the optimum payout ratio. Financial managers look closely at specific factors, like the current rate of return on investments versus the cost of capital. They carefully analyze how a dividend payout, or honestly the lack of one, will impact the stock prices and overall market value. They even use complex theoretical frameworks like Walter's model and Gordon's model to mathematically nail down the perfect balance that maximizes shareholder wealth. Section 5, Pillar 4, Liquidity Decisions, or Working Capital Management. We've talked a lot so far about long-term growth and stock prices, but this pillar deals with something much more immediate, the literal day-to-day survival of the business. This is working capital management. It's the vital everyday task of managing your current assets. A business absolutely must maintain enough liquidity, meaning you have accessible cash or assets you can quickly convert to cash, to pay the immediate bills, buy raw materials, and make payroll. Because if you fail here, you fall into the fatal trap of financial crisis and insolvency. And it really doesn't matter how many long-term assets you own if you can't pay your employees tomorrow. And this right here creates the ultimate tightrope walk in financial management. There is a direct inverse relationship between liquidity and profitability. Think about it. If you play it super safe and hoard all your cash, your risk of insolvency is incredibly low. But so are your profits, because idle cash doesn't grow. Conversely, if you aggressively invest every single dollar into fixed assets for maximum profitability, your risk of insolvency shoots straight up. Because again, you might not be able to pay tomorrow's electricity bill. So, let's pull all of this together into the financial manager's playbook. By mastering these 4 interconnected pillars, efficiently procuring funds, investing them for maximum returns, distributing the surplus wisely, and maintaining that delicate daily operational cash flow, financial managers seamlessly execute all 15 distinct functions of finance. And they do it all to achieve that modern ultimate goal, maximizing shareholder wealth. I want to leave you with this final provocative thought. Could your business actually survive tomorrow if you invested all your cash for profit today? Keep this delicate tightrope walk in mind the next time you look at any business. Consider how every major corporate move, every new product launch, and every single dividend payout is ultimately a masterclass in balancing these 4 core financial decisions. Thank you so much for joining me on this explainer, and I really hope this gives you a completely new lens through which to view the business world.